was tied up with them, they'd have lots of arrangements. There's a lot of complications because it's a regulated industry. Anytime you get in a regulated industry, you have more complications in transactions.
So is it fair to say you like these stocks and you would own more if it wasn't complicated?
Well, to go beyond 15% in any company, we would have to go in on Hart-Scott-Rodino. I mean, there's a lot of rules as you increase your ownership. Obviously, almost anything we own, we'd like to own more of.
Are you buying more of any of those stakes right now? Apple shares?
Right. I get pretty close-mouthed when it comes to what we're buying.
You thought about that for a second.
I feel my jaws lock up.
But fair to say,
it's fair to say that anything that we own, we like. There's very few stocks that we own, and I look at them as part ownerships in businesses. There's very few that are selling at some price where I would sell them a little higher.
All right, well, let me ask a question that came from Tony Dickinson. He said, in the fourth quarter, Berkshire sold 55 million shares of Wells Fargo. Should shareholders view this as a lack of confidence in the new CEO turnaround plan, and what is Warren's future outlook for Wells Fargo?
Well, I won't give him any advice specifically on Wells Fargo, but it's absolutely true that we've sold down our position. Some of it was sold down to avoid being over 10%, because then you do have some filings with the Fed and so on. But
they've sold well more than that.
Yeah, we've sold well more than that.
I think 8.4% was the last.
Yeah, that sounds right. And no, we sold Wells Fargo in the fourth quarter, and we sold it earlier.
Can I ask why? Only because I did get a number of questions.
Yeah, well, I can understand that, but we just don't want to give any advice on what we're doing, because I could change what I'm doing tomorrow. We talk about everything except we don't give stock advice.
Okay. I'll try one more from Tony Dickinson, just because I think I got 15 or 20 different questions on this. Berkshire owns $32.58 billion of Bank of America and $17.39 billion of Wells Fargo. One position's been increasing while the other's been decreasing. Does Warren like Bank of America twice as much as Wells Fargo? And how should shareholders view the holdings?
Yeah, well, I think they've seen that we bought Bank of America and we've sold some Wells Fargo.
All right, let me ask you a broader question that comes in just on interest rates and the impact that might have as well. Varun Jain writes in on Facebook, hi, I'm a huge fan and a student of Mr. Buffett. Please ask him, what impact does the zero interest rate environment across places like Japan and Europe have on their banks, whether the business is still good? And does the prolonged low interest rate regime in the United States hurt the prospects of American banks like JP Morgan, et cetera? And in such circumstances, do Indian banks, which have high return on equity, look attractive to Mr. Buffett?
Yeah, well, I can't comment on that latter. But generally speaking, but there are a lot of other variables too. But the banks are going to make more money if there are higher rates with a steeper curve. The curve is more important. In other words, the 10-year versus short-term rates may make more difference in the absolute level. But American banks have made very good money with very low interest rates. Around the world, if you look in the UK or Europe or Japan, even lower rates have made it pretty tough for banks. The returns on equity are not as high, and they have to use more leverage to even get the same returns, and I don't like that as well.
If you are talking about the curve that we're looking at this morning, the 5-year, 2-year is inverted. 2-year 10 is not right now, but the 10-year is below 1.4% this morning.
And think of it, the 10-year at 1.4%. That means you're paying 70 times earnings for something that can't increase its earnings for 10 years.
Okay,
now, if somebody came to you with a stock and said, you know, this is a terrific stock. It sells at 70 times earnings. The earnings can't go up for 10 years. You'd say, well, explain that to me again.
Right.
But no, we've never seen a situation like this in the world, literally. I mean, you can go back and read Keynes, and you can read Adam Smith, and you can read, all the great ones. And they don't talk about negative interest rate. It never crossed their mind. How much supply and demand, all these marginal costs. But brilliant economists never really anticipated that you would have negative. You've got 13 trillion or something like that worldwide at negative interest rates, and we don't know what that means. And we've got a lot of people who can speculate what it means, but 10 years from now or 15 years from now, we'll look back and say, well, it's obvious what would happen under that, and we'll see it. But it is not a normal situation, and well, interest rates are the basis of all value. I mean, if you knew interest rates were going to be zero for 100 years, you would think 1% was a great rate of return. But you also would know if you bought something that was yielding 1%, or that was what it paid, and rates went to 8%, you'd lose practically all your capital. So it's an enormous factor, and we don't know the answer. Central banks don't know the answer. All we know is that it's been useful in stimulating things, and particularly asset prices, now for 10 years. And what we thought was temporary in 2008 and 9 in the way of monetary policy to stimulate, we've just put our foot on the gas even further. The whole world has.
You made a point in the letter of saying that you don't know how long these interest rates will last. Right. You and Charlie never try and figure these things out. But we did have St. Louis Fed President Jim Bullard on the program last week, and he said that he expects to see these low interest rates for a long time to come. That does raise a lot of questions, if that happens, about what this means for the stock market, what that means for banks, what that means for insurance companies, which you touched on in the letter, too. It's
bad for insurance companies, but it's good for stocks.
Bad for insurance companies, and what happens to the insurance companies as a result? Are they getting more?
Well, it depends.
Are some insurance companies kind of pushing out risk?
The ones that really get hurt on it are either life or annuity companies that have promised returns. The property casualty business doesn't promise returns. It still holds money, so it hurts them. But if you promise somebody an annuity that's going to pay them 3 or 4%, and now you find that you're reinvesting your money at 1% or something, you're going to disappear.
Are insurance companies being forced to make riskier and riskier bets?
Well, they shouldn't be. I mean, the answer, if you need to get 3% and you're only getting 1%, the answer is to quit giving 3%. It's not to try and get the 1 up to 3 and do more dangerous things. You should always adapt your consumption to your income. You shouldn't try and adjust your income to your consumption. That's a basic principle for individuals, businesses, and everything else. And reaching for yield is really stupid, but it's very human. I mean, and I understand it. And people say, well, I've saved all this money all my life, and now I can only get 1% out. What do I do? And the answer is you learn to live on 1%, unfortunately. And you don't go and listen to some salesman come along and tell you, I've got some magic way to get you 5%.
Do you think, though, that's what should be happening? Do you think that there is more risk taking place in the insurance market as a result?
And you see that in what they call leveraged loans and weaker covenants. No, people are reaching for yield. There's no question about that, and that's stupid, and it has consequences over time. But it's very human.
Consequences that could have a big market impact.
Depends how far it goes. Yeah. It's something that the things that get built in slowly, people going crazy in tech companies in the late 1990s, it can take a lot longer than you think. Mm-hmm. But eventually you get to midnight and everything turns to pumpkins and mice.
You know, that's the downside of low interest rates, pensions, savers, anybody who gets left in a raw position of that. On the alternate side of things, if rates were to rise rapidly, or maybe not even so rapidly, what does that mean for the federal debt?
Well, it depends on the average maturity of the debt, but our maturities are fairly short. They've gotten lengthened a little. But if you take 20 trillion and you're borrowing at 2%, you got 400. What have you got? 2 trillion, 200 billion. You got 40 billion of the expense. But if it goes to 5%, you got 100 billion of expense. I mean, at 5%, you got a trillion of expense. I'm sorry. We are benefiting enormously in our national budget by the fact that interest rates are very low, and so interest cost is not gone up as you would have anticipated if you were looking at the scene 20 or 30 years ago with the increase in national debt. Austria issued 100-year bonds, at 2% or thereabouts, and then they've gone way, way up. And I think maybe they yield 1.1 or something like that. I don't know where they are now.